This episode of the Commercial Real Estate Investor Podcast is brought to you by CRE Launch Pro. This online commercial real estate program is designed to take you from beginner to pro commercial real estate investor with access to all of my courses, our online community, and monthly group coaching calls. Learn how to confidently buy your first commercial property today at www.crelaunchpro.com. Welcome back to the Commercial Real Estate Investor Podcast, live for another Investors Roundtable. Today, you just got me and Logan. It's going to be a good one-on-one conversation, basically another mastermind, what we're kind of seeing out there in the world as commercial real estate investors. And Logan, first of all, Happy New Year, man. It's good to see you back for this series, and feels good to be back for this. I mean, it's been since, December, since we did our last episode. So January was a crazy month for everybody. As some of y'all may know, I took my 30-day sabbatical, which ended January 15th, and then we got hit by this crazy ice storm in Nashville, which prolonged my sabbatical by another 8 days. So I kind of lost the month of January having to catch up on all sorts of office work. But today we're diving into, has real estate hit rock bottom? Sounds like kind of a negative term, but in my opinion, and maybe in Logan's, that's actually a really good thing. And we're going to take that apart today and discuss it. Logan, I'm going to hand it over to you because this is based on an article that you found.
Yeah, absolutely. This is something that, we have to track very closely, is what are the biggest 800-pound gorillas doing and thinking about in the industry? Are they just telegraphing, or are they actually putting money behind what they are saying? And it's similar to, let's call it the Apple effect or the Amazon effect or the Google effect, meaning if they move their headquarters to a new city, or if they open a new distribution center, a new retail location, then you better believe that they've done their homework in regards to all of the data needed to make that decision. Millions and millions of dollars of data analytics, of teams diving into that data, making bets, and strategic bets at that. And so when we start to see KKR, we start to see Blackstone, these other really large asset managers. I mean, Blackstone manages trillions of dollars of real estate. I don't even know how to count to a trillion, but I think it's 1,000 billions, if I'm not mistaken.
Yeah, I mean, if you put it in perspective, because this goes around all the time. 1 million seconds ago was 11 days, and 1 billion seconds ago was 37 years. So I can't even comprehend what trillion is compared to that.
And that's really important to understand, because these guys are legitimately holding trillions of dollars and of real estate assets. And so when they're starting to hand back keys on office buildings, when they're starting to make bets on different industries, whether that be life sciences or manufacturing facilities or anything that has to do with AI and the real estate behind that, and if they're saying, man, we believe the market has hit bottom and we're going to start moving dollars into assets, that's extremely important to take note of. And so, but that being said, we have to take the approach that is from an asset manager's perspective. Real estate is hyper local. So it doesn't mean you should just go buy any real estate, because they are, right? They have to move funds. And that is another component to this, is you must understand the way that their funds are operated. They need to be deployed. And with where inflation has been over the last 2 years, if those funds are sitting in an account, they're legitimately being lit on fire and losing their value. So they need to be deployed. So that's something to be considered as well. But when I start to see Jonathan Gray, the COO of Blackstone, say real estate values are bottoming, we would expect deal activity to pick up. We continue to see robust fundamentals. Our real estate will emerge from this cycle even stronger than before. That is a very strong sentiment. What It Takes is a book by Stephen Schwartzman, the founder and CEO of Blackstone. Highly recommend going and reading that. They made a huge bet with Sam Zell way back when, and everybody thought it was crazy. And Sam, made all this money. He did. Don't get me wrong. He made a great bet too. But these guys took that portfolio, they broke it off to, in pieces, and then sold it, and they did just fine as well. So what I'm saying is these guys have a historical perspective to keep in mind. They also said, look, we'll look back at 2023 as the cyclical bottom for our firm. And so that's interesting because if you study real estate cycles, you would know that we are in the later stages of the 18.6 year real estate cycle. It got a little bit muddy with COVID and legitimately free money coming from the debt perspective. So it got a little bit funky in there. So that could have prolonged a few different things. We've had some black swan events. A few more may happen. However, if you look over the last 200 years of the United States real estate cycle, you will see a cyclical pattern of about 14 years up and 4 years down, with a mid-cycle slowdown happening around year 7. And so, believe it or not, COVID happened 4 years ago. 4 years ago. Next month. That is wild. And a lot has happened since then. But I tend to agree that this may be the cyclical bottom because of the 18.6 year real estate cycle, because of what China is doing and what's happening in China, as well as what they're doing. Look at the stock market. Broke 5,000 for the S&P, broke 5,000 for the first time ever. Look at Bitcoin, broke 54,000 the other day, I believe. I mean, that means asset prices are still going up. And so we have to also look at 100% bonus depreciation potentially coming back. What will that do to the real estate market? How about inflation easing? I know that there was a reading that came out that it, kind of popped back up a little bit, but we're way lower than we were the last, 2 years, right? Potential rate hikes on the horizon, probably a whole lot less than what people think, but in the market's pricing in, but those, at least they are not going back up at this point in time. And then the big one, $400+ billion being raised and sitting in dry powder, meaning they are ready to deploy $400 billion of equity into real estate. So if you look at that and say, okay, those big firms alone have $400 billion. Blackstone has 202, I believe, of that 400. Then we need to listen to them. But that means trillions of dollars of real estate are likely to be transacted over the next 2 years. When does the true crash start to happen based off of the 18.6 year real estate cycle? The reading is a little unclear, but looking to be in 2026, potentially 2027. So I am seeing real estate investors start to have more confidence. Asset prices, because of fundamentals, are still strong. And I'm looking at the other asset prices, whether that be the stock market, Bitcoin, other types of assets that people hold. I don't know what gold is doing. I don't track that necessarily. But
Robert Kiyosaki?
Oh yeah, absolutely. 100% tracking that on a regular basis. I know Harry Dent and all of the guys as well. So lots of doomsdayers out there and big forecasting. But Dr. Ed Yardeni, as well as Richard Duncan and Dr. Peter Linneman, are the economists that I typically focus on because they're data driven and they don't get paid to make forecasts, because if economists were going to be right with their forecasting, they wouldn't be economists anymore. And so at the end of the day, I think that the statement that we are at a cyclical bottom, meaning prices have dropped, 15 to 25%, depending on, where you're looking at from the highest peaks, what asset class you're looking at. That's probably a correct statement, meaning they're going to go back up from where they are currently until something else happens, whether that be the real estate cycle. We've got an election year. We got a lot of geopolitical stuff going on. We've got, I've got my Kansas City shirt on, and we were just talking about this. Unfortunately, we got shootings going on all around. Obviously, those aren't black swan events, but they do put people's, fears and nerves on edge. Long story short, lots of stuff could happen. But I do think that we have a good runway of 12 to 24 months of prices probably going back up. And so, what does that mean for investors? What does that mean for folks that are owning real estate, looking to buy real estate? And that's the conversation that I wanted to have. And when I started to see Blackstone and KKR saying that they're going to start deploying funds, and if they don't, they're going to miss out, we should take note of those things, Tyler.
Yeah, I think that, man, you've raised so many good points. It's tough to even pick apart where we're going to start here, but let's take it back to what would be considered in this conversation the beginning of the down cycle, 2020. A lot of people would argue, well, how could that be the bottom of the cycle? Real estate took off, prices, skyrocketed, and transactions were moving faster than the speed of light. So walk us through why that was actually the collapse or the start of the down cycle. Oh, Logan, did I lose you? Uh-oh. Looks like we might have lost Logan there. Let me wait and see if he's going to be able to rejoin. There he is.
I'm back.
There we are.
Yeah.
I was like, oh man, he's really taking a while to think about this question. Okay, so my question was, if 2020 was the beginning of the down part of the cycle, but real estate, absolutely skyrocketed. It took off. As a brokerage, we had a couple of our best years ever. Mm-hmm. Why do you think that was actually the start of the down? I mean, I agree with you, but why do you think it was the start of the down cycle?
Yeah, obviously there's one big component here that drives real estate, and it is not necessarily where the interest rates are, but it is capital flows. And capital flows are very dependent on where the interest rates are. And so to keep that in mind, you have capitalization rates, you have debt, you have to look at where the market is in regards to what kind of debt can I put on a deal, depending on where the yield is. And so what happened was that the debt that people could put on to real estate started to get pretty well, the same amount as the capitalization rate. And so you're kind of going into a lot of deals either, at an equilibrium, or you might even be negatively leveraged in the sense that you're buying a deal at 7% cap rate, but your debt could be 8%, right? And so that is kind of what impacted, I'd say, the lull in the market. Previous to that, though, I would say that debt really fueled this kind of rise in real estate investment. But also there are some psychological components here. You have the fear of missing out. You have the rise of private real estate funds being raised and deployed, and they have not been through down markets. They have not sold and bought from Sam Zell. They weren't doing real estate, maybe not even born in 1980. I know I was not, so I am a part of that camp. That you don't have this historical perspective. And so I do think that at the end of, when you say that the real estate prices started to increase, people don't know that they're buying at the top of the market. It's very difficult to time that. And fundamentals, can get kind of out of whack when you say, but I have this big supply and demand imbalance, and, rates are going to come down at some point, and rental rates will continue to just be able to be increased over time. Some things that we've talked about in the past, operating expenses have absolutely been inflated. And so insurance and other operating expenses has also really driven some really tough situations for real estate. Then you have the fear of the office market going on as well, right? Is that going to move over to other asset classes? I don't think it is, but some people will look at commercial real estate and look at the loans that are coming due from the maturity standpoint and say, oh man, this is going to be a really bad scenario. What they don't understand is there's $400 billion of dry powder in rescue capital that is waiting there to be either structured as pref equity, as predatory lending, in the sense that they're fine putting the money in the deal, as long as they get control provisions and they can take over that deal. And those transactions aren't necessarily going to create price discovery. And so price discovery is what everybody's waiting on, right? It's like, what is that nice occupied 500,000 square foot industrial warehouse selling for today. That is what people are kind of waiting on. If Blackstone starts to make moves into those spaces, life sciences, multifamily, different types of assets, then we'll start to have some big price discovery. That will then cause a trickle down effect into smaller property owners, right? Because you can't really compete with Blackstone. It's going to be difficult to do that from a data standpoint, from a money standpoint, from the brokerage relationships that they have, all of those different components. But what they can compete on is saying, okay, well, Blackstone's buying that 500,000 square foot building. I'm going to go get that 50,000 square foot building. I'm going to make the same bet. And so I think that's what's going to happen once price discovery starts to kind of normalize. And I think that people are also willing to put lower leverage on deals because they're seeing what's happening when you don't match up the cap stack to the timetable of the deal. And so I think that's really important. One thing that is kind of impacting transactions, at least on the multifamily side, is a lot of buyers are waiting for deals that can get agency loans. And so if you don't have a strong T3, 90 for 90, if you don't have DSCR coverage ratios above 1.3, all of those different components, you're going to have a hard time getting an agency loan right now. They're being pretty picky. And so then you have to go to a regional bank, and they're the ones that are kind of in the crosshairs from a lot of Wall Street Journal articles and have already been exposed a lot on office deals and or floating rate multifamily deals. So there are some kind of variables to be thinking about there. But 2020 really, kind of started this thing where, I think that people were like, man, I can go buy a real estate deal. Once they knew that people were going to pay rent, and once they knew that retail shopping centers were essential businesses, they're like, man, debt is 3%. I'm going to go buy whatever I can right now, try to fix that rate, or maybe some of them floated it, but the smart ones fixed that rate. And they said, man, I got an asset in the debt instrument and I got real estate. And then that fueled this kind of just big upswing where property price values went to the highest. The Green Street Property Price Index went to the highest point it's ever been, and it has dropped down 15 to 20%. I'll make a post on that here shortly on LinkedIn, but it's still, kind of around pre-pandemic levels. What's different is where the debt is and where we're at in the real estate cycle, and those are important components for investors to be thinking about right now.
Yeah, I think it's really important to point out that in 2020, the start of the down cycle was artificially inflated by PPP loans, a lot of free money coming into the market, and artificially low interest rates, or even if they weren't artificially low, record low interest rates. So money was unbelievably cheap.
Yes.
And commercial real estate is 2 to 3 years behind the actual economic cycle. That's kind of how it always is.
Yep.
When I first got started in commercial real estate back in 2013, a lot of residential was starting to take off. I mean, it was already hot in 2012, and commercial real estate didn't start picking up until 14 and 15. It's just kind of how long it takes for that side of the market to really pick back up. And it's really interesting to look at the economic curves when you're going through these down cycles. So wanted to make sure we pointed that out too. Logan, let's talk about this dry powder and get a little further into it, because that's a term that everybody has probably heard ad nauseum for the last few years. Because we keep talking, there's all this dry powder on the sideline. There's dry powder on the sideline. But if you're an investor today, or you're a bank today, you're not really moving all that much. Even if you've got all the cash, you're still sitting and waiting. And so it seems like there's almost no money on the sidelines because deals aren't transacting, loans are not getting done. Why do you think that is happening? Do you think it's because they are going for more of the debt fund approach, like I want to wait until there's distressed deals, or I want to get higher, returns on every dollar that I put into this, so I'm going to sit and wait? What are your thoughts?
Well, there is another component here, multifamily, which has been kind of the darling of the industry up to this point. We have record levels of supply coming online this year. Some folks say between 650 and 750,000 units online. Historically speaking, the last 10 years, we haven't eclipsed 350,000 units. So that's almost double the amount of units coming online. And it's highly concentrated in certain markets. And I think Nashville being one of those, right? A lot of multifamily has been developed in Nashville. That's why the Midwest markets like Kansas City and Des Moines, Iowa, and Lincoln, Nebraska, and things like that, they're starting to outperform some of those coastal markets and the Sun Belt because no new supply has been developed, or at least supply to that level has not been developed. So that is one component of this is, people are kind of waiting to see, okay, and I've heard stories of developers developing a brand new product, getting it leased up and walking away from it at cost because they need to move those funds into their next deal. And so I did a little bit of research before the call here. As of October of last year, 14% of that dry powder globally was targeted for debt strategies. I've got to imagine since October, that number is probably closer to 25 to 26%. For perspective, in 2018, 21% was allocated for debt strategies. So I think that a lot of those funds have either repositioned the investment theses or they have moved funds out of certain funds and moved them into more debt strategy funds. So I think that we're going to see larger groups become the bank on a lot of these larger deals for at least a period of time, if it doesn't have assumable debt that is favorable. That too, that also being said, is like we haven't seen, and I'll say this, on the brokerage side, we're starting to get some good price discovery in that $500,000 to $3 million mark. But what's tracked is deals that are 10 million plus, right? I mean, Blackstone's not buying a $3 million deal. They're buying a $30 million deal. So you have to kind of segment those markets out a little bit too. And I think that smaller and mom and pop investors, more retail investors are definitely seeing more price discovery than the large firms are currently. And so, we have this powder on the sidelines, and I think they've been waiting for a few things. They've been waiting for the Fed to kind of telegraph where they thought they were going to go this year. I think people are pretty comfortable with that. They were trying to see, what's going on with the geopolitical risks and how that's going to impact supply chains going forward. They also were looking at, this is an election year, and Donald Trump is a shoe-in for the Republican candidate, and so that's going to be a standoff between Biden and Trump. So that's one thing that they're also thinking about, more or less from a policy standpoint than I think anything else, to try to make some decisions. But I think at what's that conference called, Davos? I think most people have gotten their head wrapped around, okay, Trump has been president once. We know what his policies were, going into it. If he wins, then we know what those policies are going to be again. That created a lot of clarity because these big guys, the 800-pound gorillas, they have to make decisions based off of policy. That's not just you and I buying a shopping center or an office building in Nashville or Kansas City. They're making, billion-dollar bets on certain things. So they have to feel really comfortable about that. So I'm seeing a lot more movement in the smaller transaction size. And most of that is because these owners who have owned those deals, we have, really strategic conversations with them and just say, look, here's where I think we're at in the market. And I think that, you have a good opportunity to capitalize on this on the next couple of years. If you miss that mark, you may have to hold on to that property a little bit longer, right? So they are thinking about that. And also, the last thing I'll say, and I'll stop talking, the United States, I believe 70% of all real estate is held by baby boomers. That means people that are, 50, 60, 70 years old. Okay. So they are holding on to their real estate longer because of a few different reasons. This is residential and commercial. One, they don't know what retirement's going to look like. Inflation really put a damper on a lot of those folks. So they may have held on to that income producing property a little bit longer than they thought. Two, the younger generation is not really interested in owning that real estate in a lot of different ways. And so they have to think about, okay, well, if I sell, what am I going to do? Well, if it's not a good time to purchase, then what options do they have? They can go to a DST, I suppose, or something like that, or they can just pay their gains. But if they've held it for 20 plus years, that could be a huge bill for them on the depreciation recapture side and capital gains tax. So you have that kind of component going on. And so I think that is causing some folks to not sell their real estate as much because if 70% of the real estate's owned by older individuals, but they're going to get to some point where they're like, I'm just too old to do this. My wife is saying, you're supposed to be retired for the last 15 years. Get rid of it. They'll get to that push point where it just is like, this is enough. I'm moving on. and that might create some more price discovery. So I'm looking to kind of see if that continues, that trend continues this year and next year, or if it's can continue to push down the road, because that will have a big impact on real estate prices and price discovery.
Yeah, and commercial's not alone on that. It's the same in the residential world, because a lot of these baby boomers, you'd think that they'd want to downsize now that they're, empty nesters and probably don't want to be walking upstairs. But they're looking at it and going, okay, yeah, I can get more for my house than I ever thought possible. But then I'm going to turn around and put that money into a 2-bedroom condo for 3/4 of the price that I'm selling my house for, or more than half the price I'm selling my house for. Why would I downsize that much and pay that much?
That's right.
So there's nowhere for them to move that capital into that a lot of them can justify, and I completely understand that. I mean, it's a crazy market out there. Let's see. Floyd is saying, "Hey, from Nashville, Floyd, good to see you in here, man. Hope you're doing well." To your point earlier about what's the 800-pound gorilla doing? Follow the big fish. I always do that. We've always recommended it in brokerage, whether you're a small tenant looking to lease space, or you're an investor, right? I mean, Target spends millions of dollars a year determining where they're going to put their next location. They have so much data to back up why they're going where they're going. Just follow them. If your target demographic is the same target demographic as Target, go sign a lease next door to them. It's the same thing in investments, right? If Amazon's going to put a 1 million square foot warehouse in Nashville, go buy a 10,000 square foot warehouse down the street from them, because there's going to be a high demand for industrial in that area.
Yeah, Tyler, on this, just to back that statement up just a little bit, and this is backing John Gray up, the Green Street Property Price Index is free for anybody. Go to greenstreet.com/insights/CPPI, and you can look at this information. In February of 2020, the indices was at 135. Okay, in July of 2020, it had dropped down to 120, and in May of 2022, we got up to 155, highest point by far of any point in time. And where we're at now is 121. So we're back to almost August pandemic levels of 120, but it's starting to tick back up. And that is because people are starting to feel more comfortable about making an investment, but they're also saying, oh, wow, pre-pandemic levels, we were at 135. At the bottom of the market, the valley, was 120. Right now we're at 121. This could be a good opportunity to purchase. Even if we only normalize back to pre-pandemic levels of 135, I can get a good basis in right now, put some good debt on it, and maybe refinance if rates come down. So they're looking at this from a price per square foot basis standpoint, and the data would show that we are very low on the indices, almost to the point of where we were at during the height of the pandemic when everybody thought the world was falling, and maybe it did. I don't know. I'm not gonna make prognostications on that. But at the end of the day, it's trending back up, right? And so how far does it go? We don't know, but it likely could go back at least to pre-pandemic levels, to the index level of 135. So I just think that is so important to understand, and in his statement is backed up by the actual data of this indices.
That's right. I mean, I've been saying this, left, right, and center as much as I possibly can, but you can refinance out of a bad loan. You can't refinance out of a bad purchase price. And
That's
so
right.
If you're able to buy real estate today at 10 or 15% or hopefully more of the value of 21 or 22 or 23, then buy it. Put up with the interest rate for a little bit. Maybe you're not going to cash flow it the first couple of years, or maybe you're barely going to cash flow. But once you refinance that loan, get it back from 7.5%, 8% down to 5.5%, 6%. It's going to make a huge difference on your cash flow. The valuation of the property is going to always continue to go up, and you're going to look good. I mean, there's never been a period in American history where real estate values have fallen and just continued to fall and never recovered. Right? I mean, everybody loves to point out Detroit, but gosh, look at where Detroit is today. You've got billionaires that are buying up as much real estate as they possibly can in Detroit. They know something that people don't, right?
Right.
I mean, they wouldn't be just buying land in no man's land if there wasn't an opportunity there.
Absolutely, man. I mean, and I'm tracking this because it's really important because many big players use this index to make strategic bets, but it actually increased 0.3% in January. That is down. So where we're at currently is down 21% below its March 2022 peak, right? So, I mean, the head of their research team says, hey, for most property types, pricing has hit its low. And so that is, in obviously office being the exception to that, right? I mean, that's a whole different conversation. There are always going to be some losers, and that has everything to do with the changing psychological and actually working habits for companies. I think there's a really interesting play in office just in general, but 21% down since March 2022 peak. So, I mean, I think that you can look at that and say, okay, well, we're in a good spot from a basis standpoint. If we can figure out how to make the debt work and or buy cash for the time being, then you're probably going to be okay for the foreseeable future. So, and that's because it's backed up by strong fundamentals. I mean, we're not looking at vacancy rates in multifamily, above 5 to 10%, right? We're not looking at vacancy rates. I mean, the retail shopping centers we're purchasing, submarket vacancies are 4%, and people are looking for space. I think it's even lower in the industrial space, right? So I think those are important things to kind of note and keep in mind. But again, greenstreet.com/insight/CPPI is a great place to go and track that if anybody wants to.
Let's get to the question that I'm sure is on everyone's minds, right? So it sounds like we're at the bottom. It sounds like it's a phenomenal time to buy, but how? How do I actually pull this deal together? How do I actually get the equity that I need? How do I actually find a lender that's going to give me the money to do this?
Absolutely. Peter Linneman said it best. If you have capital and courage paired alongside a longer term investment hold strategy, you're going to be okay. And that is important. The game of buying and the greater's fool's theory is over. And so you realistically need to go find a deal that you feel comfortable with, that the basis is there, and that you can potentially hold for 10 years, let's say. Maybe even just 7 years. Break it down to even to 5 if you want to. But there's not a big opportunity, at least in the major food groups, to go buy a deal, add some value that you think you can go vat, unless you're buying distressed, and turn around and sell that to somebody else right now. Now, that could happen here in the next 2 years. You may be able to do that, but that game has typically been gone. So there's a couple things that I'm seeing help to get deals done. One, shore up cash on your balance sheet. Lenders are really, really looking at what cash do you have on your balance sheet. They have to pitch to an investment committee the idea that if this property does not get occupied, you can carry this loan and we don't have to take this property back. They do not want the property back. So that's number one. So that means lower leverage typically as well. So you're going to be looking at lower leverage deals. 75, 80% leverage is probably gone. So we're looking at 55 to 60% leverage, which means more equity. Okay. So if you have that figured out, then you have to say, well, who's willing to park money and more money into real estate deals because of something else? And to me, it is folks that have taken massive gains from the stock market. Can you imagine if somebody put $1 million in the stock market, I don't know, 5 years ago, and that maybe the S&P was at like 3,500 or 4,000, and they're like, hey, we just hit an all-time peak at 5,000. I'm taking some chips off the table. Okay, great. Well, do that. And what do you do with that money now? Well, those CDs, those checking accounts, those savings accounts, I don't think they're paying 5-6% anymore. That was a tough thing, right? I mean, they might be paying you a little bit more than inflation, but it's not going to make you, it's not going to be a game changer for you. So it goes back to the old Tina argument. There is no alternative. So you have to pair your deal with patient capital. And that is a hard thing to do. But you have to find the right folks that are willing to say, man, I don't need this for the next 5, 10, 15 years. I really, truly want to park this thing in a safe opportunity that's going to be backed by some tangible assets and has very low risky assumptions, right? And so I think that's important to try to find right now. That's hard for retail investors, right? I mean, that's a hard sell, because we have been used to, being able to get in at 75% leveraged, and rents are going up, and interest rate is low, and all these things. Well, I mean, I think you have to get back to the historical perspective of real estate isn't this get rich, quick scheme. It's get wealthy slow. And so that may make the deal harder to come by. But if I was pitching deals right now, I would say, here's how we're de-risking this. Here's how it's very safe in regards to what the assumptions are that we're making, and you need to be willing to lock your money up for a minimum of 7 years. And that needs to be the pitch. So instead of saying, hey, I can recycle this capital every 2 years, your equity multiple is going to be 2.5, and we're going to go do 5 different deals all with your $100,000, you probably say, hey, your $100,000 is going to be locked up for 7 years. I'm going to hit a 2.5 equity multiple over that. I'm going to cash flow 5 to 6% in that period of time, and we're going to make some really low risk adjustments and assumptions to make that make sense.
Yeah, I like that. I am going to selfishly ask you a question. I wanted to kind of dive into this and get your thoughts on it. So, because of the longer term hold that we're looking at having to do with all of these assets today, there are some other options out there, right? We've kind of talked about debt and debt funds, and it got me actually looking into it over the past month of what would it look like if we went and started a debt fund that was an evergreen fund and partnered with a group. And I'm actually talking to one right now. They've funded over 1,300 residential house flip transactions, and partnered with them to do our first debt fund. And the structure is really interesting because you could place your capital in and start, it would get deployed typically within like 30 to 45 days, which means within 30 to 45 days, you're making 6 to 8% on your money, depending on how much you're putting in. You can pull it out with 90 days notice. Typically, it actually gets sent back to you within 30 to 45 days, depending on how many transactions are being done at that time. But it's almost like a glorified savings account that's paying you 6 to 8% that you can withdraw. It's relatively liquid while you're kind of in between waiting on these deals.
Yes.
I mean, what are your thoughts on that? Have you thought about going in and starting a debt fund? To me, it's really attractive because it's one thing that my investors could place capital in while we're waiting for the next deal, but it also helps diversify your investments and your cash flow and all that fun stuff.
Absolutely. I think that this is a really good strategy. The biggest component you have to look at is execution on the backside, right? So what is it that is allowing for those return of capital? Okay, if it's residential, okay, then what does the market look like in regards to buying a flipped house, or buying a first time home buyer buying a home? Because the Wall Street Journal does a really good job of detailing the challenges of buying your first home right now, right? I mean, they spend a lot of time on it. Housing is a humongous component of GDP nationally. I mean, it's one of the largest, if not the largest. And so I think that you have to look at what does that market look like on an exit strategy standpoint. And I have 3-4 buddies that I know that have done very well and are self-funding these opportunities, and not really with a certain group, but have found their own home flippers that need capital and are funding these types of transactions. That's a different component, right? Because you're taking on a little bit more risk, because if the deal does go south, you have to take it over. But a diversified strategy in regards to, hey, I'm a multifamily operator. I have a connection. I know a buddy down in Nashville that builds houses and has something very similar. But it's like, hey, we're going to partner with a group that either flips homes, builds homes, and we have 3 or 4 groups looking to us for some rescue capital and some preferred equity opportunities that we're going to get control provisions on those projects. And we're going to be at a debt instrument instead of an equity instrument. I think that is going to fall on really, really open ears right now. And I think there's a trend there that's happening with a lot of larger groups that are kind of shifting from equity to debt strategies. One thing I would just want to know is, hey, as a sponsor, as a capital allocator in that standpoint, what are what control do I have if something happens, and how do I actually go get the investor's equity back? Because we talked about this, right? They raise funds, and those funds need to be deployed, and you don't want them to be deployed in bad deals just to get deployed. So that's one thing to kind of keep in mind and keep in perspective. The overall strategy, I think, makes a lot of sense and is a very good one. It just comes down to, like any equity deal, just comes down to the operation side and what's the exit strategy, and making sure that you feel very comfortable with that. Because one thing that happens very quickly on the residential side is, that market is hit much faster than commercial real estate, right? You can sell a house in 30 days pretty quickly, and I don't know very many real estate transactions on the commercial side that happen in 30 days. And so that market is highly dependent on some of the same factors that we talked about. So just exit strategies are really important. But I love the diversified portfolio strategy, getting in on the debt side. I've also seen a lot of fund managers start to focus on different asset types, whether that be ATMs or oil and gas or something along those lines, because real estate is very difficult to find opportunities in. At the least it has been the last 6 to 12 months.
Yeah, the velocity of transactions on the residential side is what got me really attracted to this potential model that we're working on, because even in a down market, residential real estate agents flip out if a house is on market for 60 days. And I look at that and I'm like, man, if I had a commercial property that, our average sale time from list to sale was 60 days, we would be high-fiving each other in the office and losing our minds.
Absolutely.
So, let's talk about that a little more offline. Maybe it makes sense for us to partner up on that or figure out what that could look like. Because it's something that I've been thinking as a sponsor, like, it's great raising capital on a deal by deal basis, but when you're working on a deal, you don't have anything to raise for. Your investors are sitting there going, hey, we still have cash that we need to put to work. And it's kind of nice to have something that's evergreen that you're just always putting capital into.
Absolutely. 100%.
Well, Logan, what else should an investor be keeping in mind today? Knowing that BlackRock is making the moves that they're making, knowing the strategy of having to come in with 55 to 65% loan to value. What should they be keeping in mind moving forward into 2024?
Yeah, evaluating current cash flow is top of mind for me, right? It's like you have to stress test that deals now even stronger than you did before. And I think that historical cash flows is the most important thing to look at, because look, history doesn't repeat itself, but it sure does rhyme. I'm tired of going in and going to a deal and saying, man, I need to be able to sell this at this cap rate. I need to be able to push NOI at this percentage. I need to make sure that capital markets are going to be here. All of those things I can't necessarily impact. And so you almost have to dumb this thing down. And I'll give you a good example. It's like buying a 163 unit apartment complex, which we did. And going in, we had a very good basis. Thankfully, that's what saved us. But when we opened up the deal and got into it and started to realize that, oh man, people actually turn over every 6 to 9 months here, instead of, even though they have 12-month leases, they just skip, they just leave. Oh man, it's getting cold in Kansas City. This is a property on 11 acres, and they are, people are starting to move into the property that don't have leases there. What do I do in that scenario? Oh man, this property was built in 1970, and those sewer lines are getting a little bit old, and man, this one busted, that one busted. Oh shoot, we had a fire at this property and it knocked out 2 of the buildings. It's just like, wow, those are a lot of variables to try to manage on a deal versus the $13 million industrial building that has 4 tenants. It's 215,000 square feet. Those businesses have been there for the last 10 to 12 years. They're not planning to go anywhere because there is no space available. And if they did, it cost them $2 million to move their manufacturing equipment out of the industrial building. Those are the types of things that I'd be thinking about right now is, what are the steady eddies? And I posted about this earlier in the week about Kansas City being one of those steady eddy markets. And why? Well, the affordability and supply and demand, okay? But we also have some really cool things going on. We're never going to see the huge boom up, and we're never going to see the huge bust down. It stays pretty linear over time. That could change in the near future. I saw that Maker, which is a data company, has dubbed Kansas City as one of the next Austins. I think that's a little bit aggressive in a lot of different ways. It's cold here, it gets hot here, and it's in the middle of the country. So I don't think that is happening, but it has some similarities in regards to the demographic profiles and the job and demand growth that has happened. But if I look at a deal right now, I want to know what the historical cash flows are. I'm probably basing my assumptions off of that. If we get some increases because of rental rates and leases renewing, fine. But like I need to make sure that DSCRs are going to be strong regardless if we don't do much at the property. And so I'm looking for less headaches. I'm looking for deals that are kind of base hits that aren't these huge wins that have the opportunity for somebody to come, buy it for 60% more than what I paid for it 2 years ago, and taking more of just a longer term approach to holding real estate. The longer I'm in this game, the more that I'm seeing that the most successful people have bought real estate at a good basis and they just waited. I think I said on my LinkedIn post, invest, wait, appreciate, and so I think that's really important to keep in mind in today's day and age. And that's psychological. So if you go back and you read Howard Marks' book, Mastering the Market Cycle, you will understand all of the different fallacies and mental models around investing and why people continue to buy at the height and why they don't buy at the bottom. It's the old Sam Zell approach. When everybody's going right, you got to go left. Or Warren Buffett, when everybody's zigging, you got to zag. That's hard to do. But the ones that get it done right now with good basis and hold on for a long term, 5-10 years from now, they're that guy that we looked at that tax assessment deal that bought it for $250,000 and just put a $22 million loan on it or whatever back 20 years ago. Right? Those are game changers. And so I think psychologically there might have to be a massive shift in regards to investors' expectations, sponsors' expectations, and how this industry is actually done and how returns are made.
Yeah, I couldn't agree more. I mean, when it comes to commercial real estate, cash flow is great, but the appreciation is even better. Just plan to be there for a little while.
That's right.
It's really tough to buy a property and sit on it for 10 years and do it wrong, right? Because I mean, you look at we've actually done that on this channel before, and I'm trying to remember what the video was called, but I went back and looked at properties that were last purchased in the 1990s and what they're appraised for today, and some of these properties were bought for under $1 million downtown on Broadway that today are valued at over $30 million. And, of course, yeah, did they get lucky with, Broadway kind of taking off? Of course. But at the same time, they bought in a downtown center for $1 million. Mm-hmm. Like, you can't go wrong with that.
That's
Logan,
right.
this has been an action-packed episode. Thank you for doing this. Thank you to the audience for joining us for another Investors Roundtable. We're doing these every Wednesday now at 3:30 p.m. Central Standard Time live on YouTube if you want to come here and join us and ask whatever questions you have. And we will see y'all in the next one. This episode of the Commercial Real Estate Investor Podcast is brought to you by CRE Launch Pro. This online commercial real estate program is designed to take you from beginner to pro commercial real estate investor with access to all of my courses, our online community, and monthly group coaching calls. Learn how to confidently buy your first commercial property today at www.crelaunchpro.com.